And for me, I think probably in the next couple of weeks, the contract with the biggest upside is probably June, July dated, I think. We should get this buying back in the physical. It'll give you a bit of respite, if we do see a bit of kind of, I don't know, stagnation in the market for the next couple of weeks. I think May, I think, is a bit redundant now. We've only got 2 weeks left of pricing. June, July should provide an upside. It's a good two weeks for all these cargoes to clear. And the levels are pretty healthy. I mean, 50 cents on a dated spread, I think it's pretty good risk reward. You've got a good 30 cents there, I think. Hi, welcome back to another episode of Trading Corner, joined with James. So we're just going to jump straight into it. I guess the most obvious thing to talk about right now are the products, right? Really doing well, helping the margin.
I think crude's interesting as well.
Well, yeah, crude is interesting, but let's start with the product side of the margin, sure. and then we'll flip there. But so maybe if we just consider it seasonally, and then dive into each product. Yeah. So yeah, the margin's doing great, right? We've got
margins are high. So seasonally, at the moment, you'd expect refineries who've come out of turnaround.
Yeah.
And we should be kind of picking up into peak crude runs in the summer. And that kind of coincides with like driving season when most refineries want to be running. What has surprised me a bit is that even though we think this is happening, I mean, maybe the Spain outages and like there's been a few things to kind of delay it, but we've not yet really seen a pickup or the pickup in kind of crude that I would have expected.
Yeah.
And we've not seen kind of any pressure really on the products yet.
On the products, exactly.
They're pretty much, I mean, naphtha's come off a bit, but it's pretty much relatively, on a historic basis, very strong. Fuel oil, high-sulphur fuel oil is extremely strong. 0.5 fuel oil is strong. Diesel is extremely strong, and gasoline is pretty low. So basically the whole barrel is strong, and margins are super high. The market is telling refineries to run flat out, and that's not really reflected in crude spreads.
Yeah.
So it's I think it is quite an interesting kind of scenario at the moment. So yeah, personally, I feel that there's kind of like a current dislocation between the prompt and some of the deferred product spreads and the crude spreads. So margin box, I mean, it's quite a niche trade, but margin boxes are extremely high. So like prompt refinery margins are much stronger than the deferred.
Yeah.
To me, implying that maybe product spread, it may not happen imminently, but I reckon within a few months, I think product spreads need to come off relative to crude. So that could be crude spreads picking up, or that could be some weakness coming into products.
Yeah, exactly. I think every year when we come out of maintenance, we always have this kind of lead lag situation where, exactly right, you're drawing down on your product stocks, so you're getting really the run up is in the cracks. We see it kind of year after year, the kind of Q3 positioning in gasoline, it really starts performing kind of end of May into June, July, etc. This year, though, it's slightly different. It feels like the whole barrel is just infected with really strong bullishness. And I think, actually, I mean,
apart from crude,
but sorry, I'm talking about products here right now. But I think, we've spoken before about the seasonality you get in products. Like, yes, this is definitely the time for kind of the lighter products to do well. But the real standouts have been the diesel and fuel, right? So typically at this time of year, I mean, again, the lead lag, you have to admire it. You can't really, you can't force these cracks to come off. It's exactly the opposite that will end up happening. But, market chatter is everyone's trying to fade into these diesel crack rallies and get short, and it's just the opposite is happening. You have this bit of tightness in the front, and it's just helped support the front, but then also with the back.
Not sure diesel's moved a huge amount. It just hasn't come off.
It hasn't come off, yeah. Exactly. So, yeah, perhaps the lack of price action or whatever it is, it's really tempting to start shorting these outright cracks in the front, because exactly right, everyone's saying the margins are high, what's going to move first? Is it the products or the crude? So yeah, it's quite an interesting time, but you're totally right. All the products are doing particularly well. But fuel as well. What's up with the strength in fuel?
Yeah, I don't know. I mean, I think seasonally summer tends to be pretty tight anyway, and like talking to physical guys,
And that's all the aircon demand, right? Mainly in the, in the east.
Yeah, power demand, aircon. And talking to physical guys, it seems like there's not many barrels around. And I think you're seeing that in the prompt high-sulphur time spreads. I think the big question is, though, we're incentivized, like cocoa margins probably aren't that good, and CDU margins are massive. So like you're incentivizing even marginal refinery capacity to run and produce high sulfur fuel oil at these levels. So I think the question is, can fuel oil sustain the strength kind of as we go through summer?
Yeah.
And I mean, I don't love selling high sulfur fuel oil in the summer just because it tends to be quite bullish, but it is super high.
As in it's high seasonally, or
it's high seasonally. It's kind of off the chart, like at the top of the charts.
Okay.
I mean, high.
Yeah.
And given we had the IMO spec change kind of like 3-4 years ago, so like I think most people probably would have expected high sulfur fuel oil to still be oversupplied, but the market's basically saying there's not any molecules.
Yeah. I mean, if you look at the current state of the curves, the cracked, and then also the crude, which we will get on to talk about in a minute, you would assume that everyone is kind of max utilization, and that's why we're leading to this kind of product squeeze and the oversupply on crude. But I actually think a lot of the dislocation right now is due to sentiment. So we have a situation where seasonally, yes, the products are doing okay, but the crude space is totally different. We had all this OPEC, rumors a couple of weeks ago, and the market was feeling really skittish about it, which led to a whole lot of stop outs from funds. So they were long a lot of this Brent structure, especially in the front, and we saw, a lot of size going through, and it was very clear that there were big stop outs, and it led to suppressed Brent spreads. Now, obviously, that's going to impact the swap contracts as well. So we had softening on Dated, Dubai. We saw the Brent Dubai contract start to pick up. I think that curve is quite interesting. I think there's been a change in the general direction of positioning there now. So the last kind of year, 2 years, we've very much been in a low Brent Dubai environment. Makes sense. A lot of the heavy sour barrels are out of the market. But now we have Russia-Ukraine potentially, calling for a ceasefire. Maybe we'll see a bit more crude flow. Also, lower flat price means that the Russian barrels can get out. They're no longer sanctioned because they're not trading above whatever it was, $60. And then also OPEC coming out with potentially more production.
I think that's, the big one.
It is the big one, and it's definitely what the market responded the most to over the last few weeks, which is quite surprising because I thought when the initial announcement came out in beginning of April, it felt like it had priced in by that point. But I guess, the rumors are that, Saudi Aramco were going out and kind of getting the vibe of what will happen if they do genuinely flood the market, more than 440 KBD. But you could see the market didn't particularly like it, right? We had a decent flat price sell-off, decent spread sell-off. And as I said, it was all the fun. So now we've kind of settled down a little bit and we have this product strength. I think people are just a bit tiresome of playing the headlines against genuinely counting the barrels that are around right now. And also because of the time of year, it's a bit difficult to kind of take that confidence and take all the crude barrels and start put them into your refinery, etc. You always have this kind of 1 or 2 week period of weakness where the refiners are just kind of in between this maintenance and back to max running, and then obviously the Spain stuff that didn't help. We saw Repsol come out and I think they offered one cargo of TI Midland because they had to get rid of a couple or roll them back at least.
I would have thought they've got rid of way more than a couple like that. And it was completely unexpected as well. So
Exactly. So I heard BP didn't actually have to shut down any operations. But yeah, Repsol did. I think it was maybe 300 KBD, one of their refiners, something like this. So yeah, it's a decent amount of crude, a couple of cargoes that is going to pressure Dated. But yeah, anyway, now that that's kind of been taken care of, where do we go from here? I do think the kind of overwhelming impact of OPEC, etc., is still a huge problem for the market, to be honest. I think the overarching feel is people aren't that confident to be long, especially seeing as, you saw the sensitivity that happened last week, 2 weeks ago with that announcement. So I think they are going to be a bit cautious there. But, you can't really deny that you should be buying, if you're a refiner or a trade house, etc. The upside is to owning these physical cargoes.
Yeah, it's weird. And I think we're seeing that in the price. So, like, there's a lack of conviction to own crude structure, but there is, on the flip side, there's an appetite to own product structure.
Yeah.
And we're seeing that in the exceptionally high crack boxes.
Yeah. I think it kind of points to potentially people have been caught out this year. They haven't done too
Maybe,
well.
and it's right after potentially stop out. So people who've long have stopped out on crude, and
they need kind of all their ducks in a row to then go again. Right?
And also that can potentially kind of temporarily dislocate the price as well.
Yeah.
Which may be because I mean, with the volumes we heard of were massive. So
definitely. But then seasonally, I mean, I was just taking a look back at last year and the year before, and actually during this time, so May, I think we priced around -80, -90 cents on the dated diffs. We're currently pricing -35 roughly. So seasonally, compared to the last 2 years, it's actually not crazy. And last year, it took until mid-June for all these barriers to clear. It was a bit of a perfect storm last year, though, because we had, I think, 4 bull plays in a row. So I think January, February, March, and April were all bull plays. So the market really needed to reset and stay low for a long while because we just had too much crude around. I don't think that's the case this year. I think the biggest problem is OPEC, to be honest. Now, what it's creating is a higher Brent to buy environment. And so all the arbs into the east are shut, which means TI points to Europe, local barrels stay in Europe. So it's just put a bit of pressure on the dated diffs. So really, what do we need to see? I mean, either to help balance the market, either freight, maybe freight can sell off and help keep these diffs a bit higher, or the US refiners increase their utilization and they start, taking more of this Midland, and that will shut it out of Europe. But it does seem like being long crude is the best risk reward trade here.
Yeah, I like it relative to products.
Yeah, you like it relative for sure, but for me, on the curve, I mean, the only problem is if Brent buy does get a really big leg up, if that shuts all the arbs, it might be a bit more difficult to position long in kind of European crude generally, but it does seem like these physical diffs have kind of bottomed out now, and I think into the next few weeks we should start ticking up again. But again, yes, a lot of this hypothesis is down to the strength in products. So for that to materialize, I do need products to stay where they are.
Yeah, agreed. So, I mean, that for me would be a key thing to keep an eye on. So if refining margins stay high, does the market keep saying we don't have enough products?
Yeah.
And as long as that's still the case, yeah, I'm relatively constructive.
I know you were saying that the crack rolls are all doing pretty well, but how about the outright crack levels? Are they elevated?
They're high, yes. So margins are high, outright cracks,
yeah,
and margins are high, and the crack rolls are super high. I mean, that had a big part of that had been crude. So we've got, we had very negative, like deck. I think deck Brent got below -$2 a barrel. So there's been a pretty big dislocation between that and where the products are. Like, just on the product side, there's seems to be a lot of appetite to buy the more deferred spreads.
Yeah.
And I actually think that's bringing a lot of buying into the deferred crude structure because people are selling the crack rolls. So they're selling the product spreads to majors who want to buy them.
Yeah. I think contango generally is quite interesting. I mean, I think obviously for the kind of storage plays, etc., it only really matters if it's quite prompt. But if you're getting paid 20 cents a spread, let's say, I mean, I don't think it's that negative, 10 cents a spread, and you're getting paid to own these spreads. A lot of the funds that typically kind of use the curve structure to get into cheap levels, they should be looking at that thinking, Do we think this weakness is going to hold all the way into Cal 25, Cal 26? Probably not. It's quite a big structural change for that to roll up to be the prompt. So we might actually see a lot of people kind of playing that time game and only wanting to own all those spreads in contango. Let's see. But yeah, so I think the other curve, as I was kind of hinting towards, Brent to buy, that's probably the next most interesting one. So typically, a lot of the Eastern kind of trade houses, etc., that like to play that curve, they all do actually trade the same way, and it's very much a consensus market. So the fact that they, or at least it feels like they're all kind of switching to go long, it will be a totally new dynamic in Dubai. And it is a great trending market. So I think we're very much seeing the early turn of that. We tested kind of flat on the June Brent to buy for a long time. It's like kind of oscillating around there. And now it's broken through finally. And we're at kind of plus 40, plus 50 areas. So I think we could be in an environment where that stays, you know, fairly positive, like $1.50, $2. I mean, I think I've seen it as high as $4 in the past. So very much still some good upside to that contract. And yeah, that should filter down to the curve. But aside from that, I think now the market is probably, as you said as well, looking for a strong crude summer, as they typically do all year. Whether it will be an easy ride, who knows? Yeah, I think that is the one to perform. But yeah, anything else to touch upon on products?
No, I don't. No, I think
You were liking those kind of back end. Was it Q4?
yeah, so well, it was quite niche, but Deck 26 EBOB.
Yeah, is that still on the
I
cards?
still like it, not as much as it's picked up a bit. So I mean, I think I liked it slightly below 3, and it's maybe about 3.50 now. So it's moved up about
Okay.
50 cents. I'd probably still, well, I'm still holding it there, but yeah,
Not the same risk reward as it was.
yeah, it's not as cheap. I mean, if it came back off, I'd buy more, but yeah, I think if it moved up, you know, another 50 cents, or a bit more, I'd be chipping out, but
Okay.
just holding for now.
Okay. All right. So maybe we can just jump straight to the trade ideas. So, do you want to go with yours first?
I'm keeping. I mean, I do like crude relative to products, kind of a bit prompter, kind of this summer, but I prefer not trading that much at the front, just because I find it much harder to get the view right. So like, I'm sticking with my just holding rather than moving from a buy to like a hold Deck 26 EBOB.
Okay. And for me, I think probably in the next couple of weeks, the contract with the biggest upside is probably June, July dated, I think. We should get this buying back in the physical. It'll give you a bit of respite, you know, if we do see a bit of kind of, I don't know, stagnation in the market for the next couple of weeks. I think so May, I think, is a bit redundant now. We've only got 2 weeks left of pricing. June, July should provide an upside. It's a good two weeks for all these cargoes to clear. And the levels are pretty healthy. I mean, 50 cents on a dated spread, I think it's pretty good risk reward. You've got a good 30 cents there, I think, in the next couple of weeks. So that's going to be my trade session. A second one, though, I do still think Brent to buy has some upside. So for that, I'd probably position in Q3. So I think last week I suggested long Q3 data to buy, and I guess I'll hold it.
Cool.
Okay, we'll see you in a couple of weeks where we are there. Thanks.